U.S. small business sentiment slides to lowest level in more than 11 years. Consumer sentiment tumbles as inflation fears surge. Biggest miss on record for the Michigan Consumer Sentiment Survey. Yet the stock market hitting all-time highs across the board. S&P 500, NASDAQ, Dow 30, all hitting all-time highs. It's the definition of the market saying, we don't care about your opinion. Here's what we're up to. Here's what we're doing. And this is all while CPI is still coming in much hotter than the Fed wants it. The latest CPI numbers came out here today, 3.4%. So in today's video, we got to talk about where do we go from here? Are we going to keep hitting record after record high for this market, or is this just one big pump fake to suck people into a big fall in the market? Now, how you even figure out something like this, you've got to dive into the financials. You've got to dive into the most important stocks in the market and really figure out where are these stocks likely to go? Why are they pricing certain things in or not pricing certain things in, so you can understand where the market's likely headed. You can't just be, I feel like the market's going to go higher, or I don't feel like that. We're also going to look at how the market does usually in presidential election years. We're in obviously a presidential election year. I'm going to take you all the way back to the 1920s in this video here today to show you in detail exactly how the market does on presidential years all the way back to the 1920s, okay? Alrighty, folks, so this is an action-packed video here today. Hope you enjoy this one. Hope you appreciate this. This is kind of like my rest of year kind of predictions for how this market will likely trade. All I ask from you guys is to do me two quick favors. You can do it in like the next 5 seconds. One is slightly tap that like button, that thumbs up button here today. And also, make sure you hit that subscribe button. If you're not already subscribed here to the channel, make sure you're subscribed. It takes less than 5 seconds. I took hours to produce this video for you guys here today. I appreciate you, and thank you for doing that, okay? Alrighty, so first off here, we got to start at the top. The top is Nvidia, okay? When Nvidia goes, this market goes. It's as simple as that. This stock matters more to the stock market than any other stock. It is not the biggest market cap in the market, but there's no doubt the psychology around this stock, the good feelings the stock produces in the market. It is the most important stock. Tesla was that stock a few years ago, back in kind of like 2020, 2021. Nvidia's got that mantle right now. This is the most important stock in the market, and it's up 231% in the past year. Now, that leads us into earnings, okay? Their earnings are coming out next week. Now, here's what's expected. 400% or so EPS growth for this upcoming quarter, another 100% or so for next quarter, the following quarter. And then as far as revenue expectations are at 240% revenue growth for this current quarter they're about to produce. And then as far as guidance, they need to beat basically 100% revenue growth for the following quarter. They're at 97% for what analysts are expecting. Those are all beatable numbers in my personal opinion. Why do I feel confident? Like why do I feel like those are all beatable numbers for Nvidia? Okay, a few reasons. First is, if you look at Nvidia's history over the past year, I mean, they've been crushing it quarter after quarter after quarter. So to try to go against that trend and say, you know, when Nvidia is going to miss on these, that's tough. Okay, so that's first off. Secondly, maybe even more importantly, who are Nvidia's biggest customers? Nvidia's biggest customers are the biggest tech companies in the world. The Teslas, the Metas, Google, right? Google's bragging in their latest, presentation yesterday about how they're going to have the new Nvidia Blackwell chips at the end of, basically going into 2025. Amazon, all the biggest tech companies out there, right? Oracle, anybody who's anybody in the tech field is trying to get their hands on really as many Nvidia chips as possible. Now, have we gotten any details from any of these companies that they might be cutting back on the chip orders they're placing with Nvidia? And the answer is no. If anything, we've gotten more info that these companies are looking to, if anything, up their budgets. If you look at these companies' spend and you go into the nitty-gritty in regards to the financial statements, you're going to find almost all those big tech companies, pretty much all of them, are actually upping their budgets for how much they're willing to spend on things like infrastructure a la Nvidia chips. So if anything, these companies that are very well financed, that are in great financial positions, if anything, they're going to spend more and more and more here, folks. So that is something that absolutely needs to be factored in. It's not just a feeling about being beatable, it's about going into that level of detail, right? Next up here, if we look at the valuation of Nvidia, this one has the lowest bar of the bunch. If you look at their forward PE, this is looking at 1000xstocks.com. This is my service, right? And, you can compare a ton of different companies against each other when it comes to all types of different financial metrics. This is just some of the financial metrics. Forward P is, in my opinion, the most important financial metric in the stock market. That's why I list it number one on 1000xstocks.com, right? And if you look at them versus AMD, they have a lower forward P than AMD. They also have a much lower forward P than ARM. Now the fascinating thing is, if you look at Nvidia's growth rate versus like AMD, Nvidia is growing much more rapidly than AMD right now. And so the fact that Nvidia trades at a lower forward P, despite having much stronger growth, top line and bottom line, than AMD, makes it so a situation where this company actually has a fairly low bar. If this was trading at an ARM forward P of 85, I might say, ooh boy, this is a dangerous earnings here, because if they don't come in with some crazy number, then they could be set up in a bad position, right? Doesn't look like that at all. Also, one other important thing to factor in when it comes to AMD and really when it comes to Nvidia and really thinking about Nvidia the back half of this year, but really thinking about them in 2025 and beyond, very important to remember that software revenue should start to increase dramatically for this company. Software has been almost a non-existent business line pretty much for Nvidia for a long time, and that's going to start actually being something substantial in 2025 and beyond. We could actually start seeing some level of revenue growth coming for them actually in the back half of this year. Okay, so another just kind of thing to factor in there. So Nvidia sets up pretty well, which leads us then to Apple, right? Now, in regards to Apple, Apple's going to actually take over the mantle of being the most important stock in the market. It's going to take over that mantle in about, we can call it, 4 to 6 months. Okay, around September, October, Apple's going to become the most important stock in the market. Yes, Apple will become more important than Nvidia. It's already obviously a much bigger market cap than Nvidia, but when it comes to its overall sentiment, it's the sentiment around the market is going to actually start being driven by Apple starting in September, October. Okay, and the reason being is, if you know the thesis around Apple, right? Services revenue, very nice growth, but their iPhone business has been a mess. Double-digit declines in iPhone units in this latest quarter. Their iPhone business has been in a bad spot, right? But the good news is they got bigger iPhones coming in September. Okay, this is, I would say, like a 99% guarantee at this point in time. This is something I've known about for quite a while, but I think pretty much everybody knows about this now at this point in time. Now, it might not seem like a big deal, no pun intended, but it's a huge deal. Anytime Apple comes out with bigger iPhones, people go crazy. Their sales are going to go up. I would say, if I had to put odds on it, I would say there's about a 95% probability iPhone units are up quite a bit next year versus this past year, okay? And so therefore, Apple's going to become kind of exciting for a very short period of time. I don't think, Apple's necessarily the most exciting stock long term, but for the next, we can call it 12 months, it's very exciting because you're going to still have that services revenue going up, which is very exciting. But then on top of that, iPhone's going to be back to growth, right? And then additionally, they might be able to start to squeeze out some growth from kind of the iPad business and wearables as well. So when you factor in all that, that's going to kind of make Apple an exciting short-term story. Now, do I want to play options on Apple stock in the short term? No, I have no ambition to do that. But if you forced me and said, Jeremy, you got to go buy $100,000 of call options or put options on Apple for the next 12 months, I'm going to go call options. If you're going to force me into one of those situations, I would go calls, right? But with that being said, that sets up Apple pretty well. So Nvidia sets up pretty well and Apple sets up pretty well. But what about some of the other big dogs? What about Meta? What about Google? What about Microsoft? Well, if we look at the valuations, Google and Meta are very undervalued right now. Both are at a forward P of 23 with both double-digit revenue growth. You should not be trading at that cheap of a valuation if you have double-digit revenue growth and you have bigger than double-digit bottom line growth. Both of those companies are experiencing over double-digit bottom line growth and top line growth. So they're trading way too cheap right now, given the market conditions we're in. Microsoft trades at about a 33, which seems a bit rich. But remember, Microsoft's a play on one of the arguably the most stable business model in the world that's recession-proof, basically, right? On top of that, great balance sheet, great management team, and additionally, they have the AI opportunity because of their investment in ChatGPT and also what they're doing with Copilot with Microsoft as well. So it's a pretty exciting story. Meta's got, I think, a more exciting story, but people they always have trouble understanding Meta's story versus Microsoft. Microsoft's just easier to understand usually for folks, okay? So the bottom line is with these stocks, they're actually trading undervalued. given their growth rates. And so if anything, there's upside momentum ahead in those stocks. I mean, to push down, it just doesn't make sense unless those business models completely fall apart. Like if Meta their revenue started going down instead of double-digit growth, okay, it's a different story. Or it's the same with Google, right? Same with Microsoft. But is that realistic? It doesn't seem very realistic, okay? So those stocks set up pretty well. That leads us to Amazon. So is Amazon a big risk to the market? Well, the thing with Amazon is they're back to double-digit revenue growth, right? So they're back to that revenue growth story. And then they got triple-digit earnings per share growth. Their latest, EPS growth, net income growth, year over year was like 300% plus. So with Amazon, it's a hard one to really say, okay, Amazon's a risk to the market, because to be quite frank, it just doesn't look like it anymore at this point in time. Then we could talk about Tesla. Okay, Tesla, right? Tesla has been in a horrible position, we know, around sentiment for really a couple years at this point in time, right? It came back for a bit, then the sentiment fell again. And the sentiment around Tesla changes very, very rapidly. I mean, it can change based upon what Elon tweets. It's incredible, right? The thing with Tesla is there's so much bad news priced into this one that if anything happens that is a positive, it is huge for Tesla. So if Tesla has anything positive, if all of a sudden some report comes out that, let's say a report comes out in the back half of this year that Model Y units are growing more rapidly than expected, or Model 3, or let's say China growth comes in better than expected. If anything positive comes out there, it's going to be a bullish momentum for Tesla because there's so much bad priced into the stock now at this point in time. So that leads us into the weighting of the market. The weighting of the market, this matters significantly, okay? So if you didn't know, it's not just like all stocks are weighted equally. It's the largest market caps are usually the ones that are weighted the most. In the Dow, it goes based upon share price, okay? So S&P 500, NASDAQ are weighted by market cap. Microsoft, biggest market cap, over 7%. Microsoft's looking good, right? And if I'm just thinking about the next 6 to 9 months, right, you get a green check if you're looking good for the next 6 to 9 months. You get a blue if I'm a little uncertain of you, right? Microsoft's looking good. Apple's even looking good, right? Because, I mean, they've made it through their bad stuff. I mean, their numbers are already trash. The next quarter numbers are going to be not exciting either. But then you got to say, okay, then the big iPhone comes September quarter, and don't be surprised if iPhone units start to move back up, right? So we're probably already through the worst of it when it comes to Apple. Could the stock go down short term in a market fluctuation or something? Sure. Could it go back to the 170s? But are we through probably the worst of it for Apple? Probably at this point in time, yeah. Nvidia, looking great. Amazon's looking great. Meta's looking great. Google McDougal's looking great. Berkshire Hathaway, remember, Berkshire's got a lot of different businesses, but one of their businesses, well, several of their businesses are insurance related. And if we think about the insurance business, we know insurance rates are going up dramatically. Berkshire is going to likely have some windfall profits coming in the back half of this year. So Berkshire's looking pretty good, right? And then never mind if Apple stock starts to go up as well and continues this momentum upward and people get excited about that next iPhone, that's going to help Berkshire out immensely because that is their largest stock position, right? Eli Lilly is looking pretty good. Broadcom's looking pretty good. JP Morgan continues to just be the most well-run bank out there, right? ExxonMobil, Tesla, and United Health are all question marks. ExxonMobil because of we don't know what's going to happen with energy prices. Tesla, Myesla, we know there's a million things to go into there. United Health is facing some kind of, I think, government regulation problems, in my personal opinion, that's kind of happening there behind the scenes. So that one's kind of a question mark. Visa, even with the weaker consumer, even after the consumer's been hit by inflation for 3 years, Visa still puts up great numbers quarter in and quarter out. So it's hard to bet against that stock, right? So that's S&P 500. So S&P 500, I mean, I would say it's looking pretty good over the next 6 to 9 months, right? NASDAQ 100, Microsoft's looking good, Apple's looking good, Nvidia, Amazon. These are huge weights in the NASDAQ, right? Meta, 4.6% is looking good. Broadcom's looking good. Google McDougal's looking good. Costco's a question mark, right? Trades at a very rich valuation for Costco. And additionally, on top of that, if the consumer pulls back a bit, then that could hurt Costco's numbers a bit, right? And then if fuel costs go down, that could hurt Costco's top line a little bit. So just some things to factor in there. And once again, Tesla's kind of a question mark. So if looking at the question mark ones out of that top 10, they're the small positions, right, for the NASDAQ overall. If we think about the Dow, I think this is where things get a little more sus, right? If you look at United Health, that's the biggest weight, about 8.5%. Like I said, they got some government issues they're trying to work through. Goldman Sachs, I think, IPO market continues to be weak. If that does come back, that could help out Goldman Sachs. But I think Goldman Sachs, also, there's not a lot of volatility in this market, really, which could hurt Goldman Sachs trading. So I don't know, Goldman Sachs is kind of like an up in the air situation. I'm not super confident in Goldman Sachs. Microsoft, yeah. Caterpillar's kind of a question mark as well. Their revenues actually went down slightly in their latest quarter. That was a little troubling. Home Depot trades at a little rich valuation from where it should be trading, in my opinion. Also, their numbers are, somewhat depressing right now. They're not like off a cliff, like horrible numbers, but they're not exciting numbers at all. Look at their comp store sales and you'll see that. So Home Depot's, I think, is a question mark. Amgen's looking pretty good. Visa's looking pretty good. Salesforce looking pretty good. McDonald's is facing a whole host of issues, so we'll see, what happens there with McDonald's. And then American Express, they really deal with a lot of the higher end consumers, which higher end consumers continue to be in a pretty good place. So, but overall, if I was to say there's an index that, I'm a little more suspect of, it's actually the Dow. And, a lot of times some of the bearish folks, they try to poke at the NASDAQ or some of these tech stocks. I think if you want to poke holes at any index or anywhere in the market, look to the Dow more than the NASDAQ and more than the S&P 500, okay? That leads us to the last of the major indexes, which is the Russell 2000. Now, the important thing to remember about the Russell 2000 is this index has performed horrible for the past 3 years. The index is down over 7% in the past 3 years. Now, meanwhile, the dollar has been eroded massively over the past 3 years. Everything else has gotten much more expensive pretty much out there over the past 3 years, and yet the Russell 2000's gone negative 7 percentage points in the past 3 years. So, which really speaks volumes. If you were really to put the Russell versus, let's say, inflation over the past 3 years, you could be talking about a negative 15, 20% type number in reality versus inflation versus CPI over a 3-year basis. So Russell's bad, okay? But here's the deal with the Russell. One is, it looks like it has bottomed. And it looks like at this point in time, it looks like a real comeback of the Russell. These kind of initial kind of up and downs, it wasn't clear, but now we've kind of had this explosion upward. We've kind of recently traded around the highest we've traded in years. So it looks like the Russell's actually for real starting to come back to life. Now, here's the deal for the Russell. In order for folks to buy the Russell and stick money into the Russell 2000 stocks, they have to be confident that rates are not going higher. Not going higher. If people are worried rates are going to go higher, they're not going to buy the Russell 2000. That's as simple as that. These small cap companies, they don't want a piece of it. If they can become more confident, right, and comfortable that rates will be low or they're going to go lower from here over the next 6 to 12 months, then they say, okay, let me start to position into the Russell 2000. And I think that's really what has emerged since that bottom kind of in late 2023 is I think there's a view that, and of course the view can kind of shift up and down a little bit, but there's still an overwhelming consensus for the Russell, in my opinion, since late last year, that rates are going lower. It's just a matter of time of exactly predicting exactly what month or what quarter they're going to go lower, but there's an overwhelming consensus that rates are going lower. Now, the other thing you need for the Russell 2000 to go higher is you need no major recession fear, right? You need to be in a time period where people either feel like the economy is going to get better or it's going to kind of stay around where it's at. Maybe get slightly worse, maybe do slightly better, but it's not, there's no major recession fears, okay? And if we think right now out there, are people confident rates are likely going to go lower? Well, we'll get into that in just a moment. But it's important you understand, look at this. This shows you the Russell 2000 from 2009 to 2020, right? And this shows you the performance here overall. Now, check this out. The only times the Russell ever had troubles was in time periods when people were fearful rates are going to go higher. So 2017, 2018 are a perfect example. The reason being is the economy started to really heat up and people started thinking, oh boy, the Fed's going to have to start raising rates. And there started to be a view in the market started in 2017 and really got going in 2018 of rates are going to go higher. This is going to be bad for Russell stocks, right? Then the Fed changed course and they actually started to lower some rates, right? And so Russell went through a boom cycle because people started to say, okay, recession's probably not coming and rates, if anything, are going lower. So we're feeling great. T-Man put a lot of pressure on J. Powell to basically start having rates go down. The market tanked about 20% really quickly in late 2018 and all of a sudden, boom, Next thing you know, Jay Powell and the Fed started to go the other way, right? And boom, the Russell boomed, obviously, right? 28 percentage points roughly up in 2019. 2020, obviously low rates, right? And then, by the end of 2020, people were less fearful of recession. They kind of felt like the worst was behind us. And so the Russell had a good year. It was up nearly 10 percentage points. If you look at 2012, 13, 14, 15, 16, Russell did great all those years. And the reason being is people were very confident that the economy, if anything, was getting better, healthier, right? And they were also confident that rates were going to stay low. There was no, the Fed's going to raise rates during that particular time period, right? 2011 was a little tough for the Russell 2000. Russell went down about 1% during that particular year, but there was a lot of double dip recession fear during that year. So it wasn't a fear of rates are going to go up. It was just a fear of maybe we're going to go into another big recession. I mean, that was something that was talked about immensely during that particular time. 2009, 2010 were great years for the Russell 2000, 22% up, almost 23% up, and nearly 37% up in 2010. And the reason being is rates were insanely low. Was the economy booming in 2009, 2010? No way. No way. Economy was in a horrible spot in 2009 and 2010. But the Fed just lowered rates to zero. And so Fed lowered rates to zero, like Robert De Niro in Last Action Hero. He was never in that movie. And the market said, buy small cap stock, buy Russell 2000. And so it's relatively a simple game when it comes to Russell. As soon as people feel like recession's probably further away than 6 to 9 months out, and as soon as they feel like rates are going lower or going to stay low, they buy up Russell stocks, right? And all of a sudden those ones start to perform tremendously. Remember, Tom Lee still has a call that he thinks Russell stocks are going to be up 50% this year, these small caps, right? And we haven't even gotten remotely close to that performance. We're starting to get some performance, but if Tom Lee's correct, there's a lot to run there, right? That leads us into inflation overall. Now, there's still a lot of problems with inflation, right? And energy is helping us out immensely right now by not being a problem. That could be a problem down the road. So just a little food for thought in regards to that. It's not a problem, but it could be a problem. 3.4% CPI is still up year over year. The issue is we still got a lot of problems with these inflation numbers. I don't know if you guys look at these numbers in detail, but I'm telling you, here's the deal. Okay, wages are up about 4.3%. So I like to think about this as, okay, what are the expenses that, major expenses for people out there where they're spending more than 4.3% up year over year, right? And there's a lot of them. So personal care and services, haircuts and other categories, right? 4.7%. So you're basically losing out to personal care services. Internet's up about 5% roughly year over year, so you're losing out to internet. Water, sewer, trash collections up 5.3% year over year, so if your wages only went up 4%, you're losing to that. Your rent went up 5.4%. Which is over it's over 100 basis points higher than wages went up. So losing out to that. If you got a pet, you got a dog and something happens to it and you need to take it to the vet, it's up 7.1%. So you're losing to that. Non-prescription drugs up 7.7%. Outpatient hospital service, 8.2%, nearly a double up of what wages are up year over year. Motor vehicle repair up well over double what wages are up, 9.8%. Care of elderly at elderly homes, right? Up almost 14% year over year. Motor vehicle insurance up over 22% year over year. Meanwhile, people's wages are up about 4.3%. So the bottom line is, people try to pitch inflation all these different ways. Inflation's still a problem. It's still an issue. Is it better than it was? Sure. But the bottom line is you look it through, these are needs-based things that people really have to use. Internet isn't really an option nowadays. You got to have internet in your house. Are you kidding me? This isn't 1993 anymore. Motor vehicle insurance, motor vehicle repair, these sorts of things. I mean, it's brutal. So the bottom line is inflation's not done. We're doing better, but we're still getting punched in the face when it comes to inflation overall, which means the Fed, Jerome Powell, he still can't make his move yet, right? Maybe he can make his first cut 3 to 6 months from now, but that's a maybe. I wouldn't be super confident in that. Maybe he cuts in 3 to 6 months. Maybe. We'll see. We'll see in regards to that, right? But the overall consensus still is rates are going to go lower rather than higher, right? Which I think makes sense overall. Now, additionally, you have an insane amount of money on the sidelines, well over $6 trillion. So as of Q4 2023, it was $6.3 trillion in money market funds. That number could easily be 6.5 trillion in when the latest numbers come out, if not $6.6 trillion. So at some point in time, I think about $1 trillion of that dollars, well, half a trillion to $1 trillion will make its way to the market. Now, some people had this false assumption that all 6 trillion plus is going to come into the market at some point in time. And they talk like that, and that's just wild because that never happens, okay? There's always going to be an insane amount of money in money market funds. Even when the market drops significantly low, there's still about $3 trillion in money market funds during that time. But could I see a half a trillion come out of money market funds and go into the stock market, or, $1 trillion? I think that's possible. Like, let's say we went to 6.6 trillion, then over the next year it went down to 5.6 trillion or something like that. That's always a potential, right? People get more bullish. They I can't have money here. Let's say Fed starts lowering rates. What you can get from treasuries and other things just go down. Savings accounts. Maybe people say, I'm not getting quite what I was. Let me get into the market. The market's running good. They start to feel more confident about the economy or whatever. And that's a situation you have to play out there, right? Now, we're obviously in an election year, and how does the market usually perform in election years? So first off, it performs very well overall. This is data looking at 1928 through 2016. And so here's kind of the results. If a Republican was elected, the average return was 15%, right? This is a confusing election because if I went by who I think's going to win, it's tough. I do think T-Man's going to win, but I don't know what's going to happen with him with all this court stuff, so I don't know. But if I had to put money on it, I would say T-Man's probably going to win. But once again, he's got whole court situations, and I don't know how all that's going to factor in. But if a Republican wins, 15% average return, over 15%. If a Democrat wins, 7.6%, so roughly in what the market usually goes up, right? All election years, over 11% return, so much higher than the average year. So the moral of the story is, in election years, usually the market's very good. Very good, regardless of who's president. But if a Republican gets elected, that's even usually better for the market in that particular year, right? Now, if we think about the only years that were negative years, right? You have 1932 was negative, 1940 was negative, then we got to go all the way to 2000 was negative, and then 2008 was negative, right? But the thing with all those years was those were extraordinary events going on, like earth-shocking, like crazy stuff was going on, right? 1932 was the Great Depression. Like we were literally we were in the Great Depression during that time, right? When the market went down 8%. 1940, that was during WW2. Insane, right? During 2000, it was the biggest market bubble in history, the tech bubble, right? People try to equate this, the market we're in right now, the tech bubble, that just shows me they don't know anything about the market. When we're talking about the tech bubble, we're talking about a time period in which there were companies that had hopes of maybe having revenue someday that were trading at, ridiculous valuations. To say we have a tech bubble today is just not understanding anything, to be quite frank. Understanding how the market works, understanding valuations, understanding what actually transpired during the tech bubble. There's a big difference between Meta trading at a 23 forward P that is one of the most important companies in history that has actual insane revenues and insane profits, right? And an Apple trading at a 25 forward P or 26 or whatever, right? And a Microsoft at a 33, and an Nvidia that's trading at a 41 forward P, but will probably destroy their numbers throughout this year. And companies that have hopes of maybe having a business model someday that went under. That's a big difference there. It's a big difference between people investing on, we think the internet's going to be big someday, so let's just throw money out there, versus like these companies are like the big companies now. Big difference there. So, nothing like that. And so, obviously in that 2000 election, that was a tech bubble was going boom, right? And then 2008 election, we were in the great financial crisis at that particular time, right? So that was an extraordinary situation. So do we have anything extraordinary going on right now? No, nothing like that. We're not in the Great Depression. We're not in the Great Financial Crisis. We're not in the tech bubble, and we're not in WW2. So unless something absolutely shocking happens in the next 6 to 9 months, looking pretty good for this election year. So just a little food for thought in regards to that, right? And by the way, 2020, because I know they didn't have 2020 up there, if you're wondering how the market did in the B-Man election there, it was up over 16 percentage points during the 2020 election. So yeah, moral of the story is if you're going to think about how does the market going to likely do in an election year, It's going to likely do good, and it's actually going to likely do much better than an average year, right? So just a little food for thought. To see the market up, 15, 20, even 30% on an election year, it's not crazy. We've seen it so many times before, right? So just a little food for thought in regards to that. And by the way, T-Man, I told you, if I had to put odds on it, I think he probably wins. I think the market really wants him deep down. And the reason being is, B-Man's talking about going up on corporate tax rates to 28% from 21%. I don't think they want that. There's also some talk about going up on some capital gains and things like that. And so I think the market wants B-Man out. I'll just be honest with you guys. That's my personal opinion, and we'll see what happens there, okay? Now, so the next 6 months, I would say for the market, I would say it looks pretty good, but don't get cocky. Don't get cocky about this, okay? Just because it looks pretty good, things look like they're shaping up pretty good for the next 6 months, you don't want to get cocky about this, okay? Stay away from call options, stay away from margin, things like that. It's much better to look back and be like, dang, I wish I bought some calls in the market, or I wish I was margining out money than be in a situation. Because as soon as you go start loading up on call options, start loading up on margin, that's the moment where all of a sudden some black swan events come out of nowhere and slap you in the face. You're like, what the heck? Just as soon as I load up on calls and load up on margin, I get absolutely wrecked. You don't do that stuff, guys, okay? Even if you are pretty confident that the remainder of the year will be good, because it just usually sets you up for some bad stuff, right? The public account, for instance, I have that set up so if I ever want to do margin, I can. I'm not going to do margin. I have no interest. It's really just so I can invest money as soon as I put it in. It doesn't have to clear for 3 business days and all that, right? But Fidelity will let me do $1.7 million of margin right now on the public account if I wanted. $1.7 million, right? They'll let me do another $861,000 of options buying on margin right now if I want it, right? And sure, could I turn the $861,000 on calls into 1.6 mil or 2 mil over the next 6 months if things went really good? Sure. But I'm not willing to lose $861,000 out of the public account in that given amount of time, because there's a lot of things that could come out of nowhere that all of a sudden, what happens if the economy deteriorated massively much more quicker than people expected? What happens if all of a sudden banks started to collapse out of nowhere, right? And some things are hidden in the banking system that no one really knew about, right? There's so many things. What happens if, China, Taiwan? I mean, there's a lot of things that could just come out of nowhere that could just completely wreck you and kind of wreck your thinking of oh, we were supposed to be smooth sailing and then it didn't end up smooth sailing. So that's why I look at something like that and I say, good, if my account, if this says $3 million 6 months from now, good. And I didn't have to margin out a penny to get there, I'm happy with that. I'm happy with that. I'm not dissatisfied, I'm happy. I would rather say, oh, you know what, I should have margined because I'd be at $4 million now or something like that. I'd much rather say that than a whole situation where I get destroyed and then the account gets destroyed, right? This wasn't built overnight. The public account, $2 million plus portfolio, this has been built over years. I started that portfolio, what was that, 2018 or so, right? Years ago, way prior to Rona and all that stuff, and just been building and building and building and building to now it's a $2 million plus portfolio. The house I live in, this wasn't built overnight. This is built over the past 15 plus years. Everything I got was built over a long period of time. It took patience, grinding to get there. And so a lot of times people want to try to, bypass the steps and try to get the quick way to the big house and get the quick way to the financial freedom, if they want to call it that, or the big portfolio and all those things. Stay away from that crap, guys. You got to be patient with this stuff. Put in the work. Stay patient, let things work out for you. When you try to rush it, whenever I try to rush things in the past, it always ends poorly for me. I like to stay patient, stay disciplined, and whenever I do that, I do really freaking well for myself. And people look back and like, damn man, you're done pretty dang good for yourself. Whenever I try to rush stuff, that's when I get sloppy. That's when things don't work out for me. If I think about 2015, that was a situation I tried to rush. I just wanted to hit millionaire status as fast as possible, and I hurt myself significantly in 2015. And then, if I think about kind of, the chef situation there, trying to rush, kind of trying to instead of looking for the easy pitches to hit, right? Looking for something that was hopefully a grand slam that no one else saw and poorly. And so anytime I try to try to push the game way faster than it should go, it ends poorly. And when I stay disciplined in the game and stay focused and put in the work and put in the patience, my gosh, things just open up and open up and open up. Public account back in late 2022 was $1 million. You know, here today it's over 2 million. And that's on minimal deposits since that particular time, right? Just staying patient, staying focused, I swinging at the pitches that I think are likely going to be home runs for me. And then the pitches that it's like, I don't know, man, it might be a grand slam, but it might also strike out here. Those ones, you know, staying away from those, or if I do risk anything in those, is small amounts of money. And then everything else takes care of itself. And so let that be a little, you know, stepping stone for you guys all watching this video right now. Don't be in such a rush to you know, try to hit that next number or things like that. Let the game come to you, as Warren Buffett puts it, right? You know, swing at the pitches that are in your circle of competence. Buffett, he's somebody you could look at and say, man, Buffett, you missed out on so many opportunities. You missed out on Amazon. You missed out on Nvidia. You missed out on Meta. You missed out on Google. You missed out on Apple back in the day, right? He's only gotten the little gains from Apple over the last, you know, several years, not the big gains from Apple back in the day. You missed out on all these NASDAQ stocks. And we could all poke Buffett, as still, at the end of the day, he ended up one of the richest people in the world. Think about all the pitches he missed out on. Oh, you should have bought Bitcoin, Buffett. And yet he still ended up one of the richest people in history, right? And, you know, he has more money than he knows what to do with, which is why he's going to give away 90% plus of it to charity, because it's just, I mean, you don't even know what to do with all that money. And so, you know, gotta stay patient in this game, guys, okay? All right, I appreciate you joining me. That's kind of my year-end outlook there. Hope you guys enjoyed this. Hope you got a lot of value out of this video here today. Let me know in the comments section if you got a lot of value out of this video here today. I appreciate when you guys let me know, hey, Jeremy, that was an awesome video. I really enjoyed that, got a lot of value out of that. That means the world to me to kind of read those sorts of comments and whatnot. Also, I put together an in-depth 32-minute video for you guys. It's a workshop. I put that together last week for you guys. It goes all into detail on the 7 steps to reach 7 figures plus in stocks. I put together my 7 best tips in there and exactly how to implement those and utilize those steps. So that will be the pinned comment down there. If you want to sign up for that, I'll send that over to your email, and you can go ahead and watch that video, okay? Much love and have a great day.